SoFi, straight banger from SoFi. Oh my gosh. If I had to compare them versus PayPal, I liked it. I didn't love it. SoFi, banger. Check this out. SoFi reported Q3 earnings Tuesday, 5 cents per diluted share, swinging from a net loss of 29 cents a year earlier. Analysts polled at expected 4 cents, so they beat on EPS, right? Total net revenue for the quarter, ended September 30th, was nearly $700 million versus 537 a year earlier. Analysts were at 633. Anthony Noto? What are we doing over there? Oh my gosh. A beat like that is ridiculous, especially in the banking space. And obviously they're more than banking, they're tech, but I'm like, oh my gosh, dude, that's insane. This is brilliant. The company said it now expects full year earnings per share of 11 to 12 cents, up from its previous forecast of 9 to 10 cents. Let's go, baby. Analysts were expecting 11 cents. Oh, this is good. But it gets better. It gets so much better. Look at this. This is members. I call them customers. SoFi calls them members, okay? They're up to nearly 9.4 million members. This essentially means that likely 2 quarters from now, 1 to 2 quarters from now, it's a big question, is it 1 quarter from now or 2 quarters from now? Likely 1 to 2 quarters from now, SoFi is going to reach the big milestone of having over 10 million members, which there's not a long list of financial institutions that have over 10 million members. SoFi is likely going to be there in the next 1 to 2 quarters. It's just a question of, do they reach it next quarter or the quarter after, right? Incredible. New member additions of 756,000 in Q3, bringing the total to nearly 9.4 million members, 35% year-over-year increase. These numbers are getting big. And I'm going to explain to you something that's going on here with SoFi's business model that I think is attracting a lot of new members here, okay? Now, there's actually two things I'll go through with you guys. Galileo, think of Galileo as really their tech side, right? Galileo accounts went to 160 million. And if we look at the same quarter last year, they were at 137 million, right? 17% growth year over year. Tech side looks good, looks strong like Donkey Kong. Look at this. Quarterly adjusted net revenue, $689 million. In the same quarter last year, 531. This might be the most impressive thing of everything, right here. Look at the EBITDA margin, earnings before interest, taxes, depreciation, and amortization. That margin came in at 27% for this quarter. If we look at this same quarter last year, they were at an EBITDA margin of 18%. That's a 900 basis point improvement. You're going to be flipping my flapjacks. Oh my gosh. Quarterly adjusted EBITDA, $186 million from $98 million in the same quarter last year. Whoo-wee! If we look at the trailing 12-month performance here, adjusted net revenues, $2.46 billion. That's incredible. Adjusted EBITDA on a trailing 12-month basis, $650 million. Net income on a trailing 12-month basis, $214 million. Now compare that with previous years, right? 2023, they lost $301 million. 2022, they lost $320 million. 2021, they lost $484 million. They have flipped this baby over to profitability, and it's going up rapidly. Oh, baby. Now, check this out. This is the numbers they did versus what they had guided to. They had guided for revenue 625 to 645. They did 689. That's still insane to me. Adjusted EBITDA 186. They were expecting 160 to 165. They blew that out of the water. GAAP net income of 61 mil. They were expecting 40 to 45 mil. They blew that out of the water. Diluted EPS of 5 cents. They were expecting 4 cents. Now, as far as their guidance went, look at this fiscal year 2024 guide. Financial services net revenue growth of more than 80%. Versus 2023 levels. Lending adjusted net revenue of at least 100% of 2023 levels. Oh my gosh. GAAP net income of $204 to $206 million. I wouldn't be surprised if they come in and still beat that. Adjusted EBITDA, once again, earnings before interest, taxes, depreciation, and amortization, 640 mil to 645. Jeez. Member growth of at least 2.3 million. Or 30% from 2023 levels. They're taking market share, folks. That's what we call that. Taking market share. I would not want to compete against these guys. They're taking the younger generations. from these big traditional banks. And then as those younger generations' net worth grows, oh my gosh, it's going to be game over. Like SoFi, this is how SoFi is going to become a financial giant. Like I hope people really understand what's going on here with SoFi. Like I hope they really get it. Like SoFi's coming in, they're attracting a ton of the younger generation, right? They're getting those folks to be their customers. Those folks have lower incomes right now, right? As they age, they get better jobs, they start their own businesses, their net income goes up, their net worth goes up, right? They're able to get into other financial services products that SoFi offers, right? And SoFi is able to generate a lot more money off of those consumers over time, right? The money they're holding at the bank, all those sorts of things, right? The interest they're paying, everything. And so SoFi is able to become a financial giant over a 10, 20, 30-year span. That's how it happens, right? And they're doing it they're executing as well as I've ever seen any financial ever execute, just to be quite frank. Now, look at this. Loans and securitization, $671 million, almost $672 million. That's from $539 the same quarter last year. If we look at other, that was 51 mil versus 24 mil. If we look at total interest income, $723 million versus 564. Total interest expense, 292 versus 219 the same quarter last year, which I love that. Like, sure, it's up, but it's like not even up remotely close to as much as the interest income's up, right? Which means their net interest income, which is basically just taking the total interest income and subtracting the total interest expense. So net interest income, NII, which is one of the most important metrics you can ever look at for anything banking related, $531 million versus 344. Woo! Total non-interest income, $266 million versus $192 million in the same quarter last year. Total net revenue, $697 million versus $537 million in the same quarter last year. Oh my gosh. Now, technology product development, 139 versus 125. So that was up year over year, but it wasn't like some crazy increase. Sales and marketing, 214 versus 186. So they're obviously spending a lot more on marketing, but it's doing its job. It's doing its job phenomenal. Cost of operations is 123 mil versus 98 mil. General and administrative, G&A, 148 versus 124. These numbers are all like right in line with where they should be, considering the growth rate in interest income and net interest income. I mean, those growth rates are so phenomenal that, you know, sure, these are going up, but they're what you would expect from a nice growing business, right? Now, something that helped their bottom line out immensely was goodwill impairment. They had a goodwill impairment charge last year of $247 million in this quarter. That one-off did not exist this year. And so, thank goodness, right? So that helps their bottom line phenomenal. Now, also, I think this is interesting. Provision for credit losses, only $6 million versus $21 million in the same quarter last year. That's positive. Total non-interest expense, $633 million versus $804 million. Once again, a lot of that was that huge one-off goodwill impairment there. Interest before income income before income taxes, 63 mil versus 266 mil loss in the same quarter last year. Net income of $60 million versus a $266 million loss in the same quarter last year. EPS on a diluted basis, 5 cents versus a 29-cent loss in the same quarter last year. Grade A- income statement from SoFi. Bravo. Additionally, we look at the balance sheet and we're looking at equity now of $6.1 billion versus $5.2 billion of equity in this, or at the beginning of, at the end of 2023 there, right? So that's a huge increase in just a 9-month span. Incredible. Right? Now, SoFi is attracting a lot of customers 2 different ways right now, in my opinion, okay? They attract customers a lot of different ways, but I think there's 2 core ways they're attracting a lot of customers. One is through their savings account product, right? They've, very good savings account product that offers you a pretty high return, right? And additionally, you can set that up with direct deposit. So, your money goes through your checking account and then basically you're able to start generating in savings. I believe last time I checked, it was over 4%. It was over 4% what you could get from SoFi. So I think that's attracting a lot of folks, especially a lot of folks that might be creating their first bank accounts and things like that, right? Additionally, you have this other dynamic that's going on right now where, we all know credit card debt's gone up a lot over the last couple years. That's no secret, right? You can look at any credit card debt chart out there. So the more sophisticated folks, they understand there's kind of a hack that they can do to strengthen their position. So let's say, you owe $5,000 to a credit card company, right? Discover, or I don't know, American Express, whoever, right? But you don't really have that $5,000 to pay it off right now, right? And keep in mind, credit card companies usually charge crazy APYs. It might be 25%, it might be 27%. It's like crazy numbers, right? So you would look at that situation and be like, crap, I don't have the money around to really pay this credit card off right now, right? Or I don't want to blow all my cash around to pay this off. So what you could do is you could look at somebody like a Sofi, right? And so that same person then looks at Sofi and takes out a personal loan with Sofi, right? If they get approved, that is. So they go through the process, they get approved for Sofi, they get their $5,000, right? And now they have to pay back that $5,000, let's say 11% APY versus a 25% APY, right? So then they go ahead, take that $5,000 and pay off the credit card debt, right? So now, essentially, they put themselves into a situation where they still owe $5,000, but the difference is they owe $5,000 at a much lower APY versus an insane APY, right? And now, Sofi is the one who makes all the interest on this. So everybody ends up winning in it. You could say maybe the credit card company wins the least because they don't collect all that crazy amount of interest over time, right? The 25% or 27% or whatever it is. But at the end of the day, that credit card loan's paid off, right? Sofi begins to make all that interest, and then the customer's happy because they just probably cut their APY in less than half, right? They're probably paying it's probably like a 50%, 60%, 70%. It could even be an 80% improvement for them versus what they were paying a credit card company. So I think that's another way Sofi is attracting a lot of customers out there, right? And if people have good credit scores, if they have a good credit history, like Sofi is pretty generous with those personal loans. And, because they feel like, if you got a good credit score, if you haven't burned companies and whatnot, in regards to this, you're probably going to end up paying this off to Sofi. And so, it's a good way of generating new customers. And then somebody starts out with that loan with Sofi, right? They pay that off over time. And then Sofi says, we also have this savings account product over here, right? We also have this invest product over here. We also can do certain types of insurance over here, right? When you're ready to get your next mortgage. And so all of a sudden, once you're now in the ecosystem, now they have like 1 billion different products to sell you, right? And so that's what it's all about, getting that customer through the door. And then expanding that relationship and somebody getting more and more in the ecosystem and used to using this and using that with Sofi, right? So I think that's the two ways they're attracting a lot of customers right now. Not the only ways, but I think a huge portion. Was I out there buying shares here today? The answer is, I sure was. I bought 400 shares in one of my portfolios today. $10.54 I paid for those shares. I had to do it. Like the earnings were too damn good. Too damn good. I couldn't sit on the sideline and say, yeah, that's great earnings. Like, man, they blew away what I was expecting, what everybody was expecting. But, I'm not going to buy the stock. No, this was a gift. This was a gift. It was a gift today. That's the bottom line in regards to that. I had to take advantage. Now, where's the stock going from here? My opinion is we're now going to round trip this thing. We're going to move all the way to Jumpman. 5% of people probably got that reference right there. Look at the chart. I say we're going to move to Jumpman. I think 95% of people don't know what I'm talking about right now. But the 5% that know, you think that was clever, okay? So my opinion is we round trip this thing all the way back to Jumpman over probably the next 12 to 18 months. And if they keep coming through these earnings that they just came through with here, we'll be there within 12 months. We'll be back to Jumpman within 12 months. And that's back to where it was, back at the end of 2021. And that was a whole different type of market now at this point in time. But you think about Sofi, right? There's an argument to be made. We should already be back to Jumpman right now. We should already be back to 23, right? Think about this for a moment. Think about where the company was back in those days. Think about where their losses were, their member profile was. Think about where their revenues were. And think about how unproven they were. And think about the fact that we hadn't gone through an interest rate hike cycle yet. And now think about where Sofi is today. Think about how many members they have now at the end of 2024 versus end of 2021. Think about their net income versus their insane losses they had back then, right? Think about now that we're going into a cutting cycle from the Fed rather than an interest rate hike cycle. And you start to say, gosh, like Sofi is in a pretty damn good position. So there's an argument to be made that we already should be back to where this stock was back in 2021. And it's a strong argument that could be made. But my opinion is, the bottom line is, we're going to round trip this whole thing over the next 12 to 18 months, all the way back into the 20s, all the way back to that $23 number. And then we'll see where earnings are coming out after that point in time. And maybe we make the next move up to 30 and 40. But first things first, we're going to round trip this baby to 20 plus, and that's going to be a lot of fun. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Let's get into this.
CEO Anthony Noto. Anthony, great to have you. We mentioned the price action, although we should also point out stock's been on a bit of a tear lately.
Yes.
Can you talk about what the quarter brought?
Sure. Thank you, Carl, and thanks for having me on. This was the strongest quarter.
Yeah, you know, everybody got tied up in, well, the stock didn't go up today. Who cares? The stock's going to be going up a lot. So the stock had ran huge into the earnings. The stock's going to likely run a lot from here. So the fact that it didn't go up today on the earnings day, who cares? And like, maybe the people care that are playing short-term call options on this, it's irrelevant. Like, all that matters is the numbers are great. The stock's going to be going up a lot.
Company's history since I joined in 2018. We saw an acceleration in our revenue growth to 30% year-over-year growth. Importantly, we're not just a lender anymore. We saw 64% year-over-year growth in our financial services and technology platform revenue. Those are high margin revenue streams, high ROE and capital light. And so we continue to diversify the business. We've been able to overcome a really tumultuous environment over the last 5 years, both in terms of rates, in terms of the pandemic, in terms of student loan refinancing, to deliver 17 quarters of record revenue. And this made it number 17. In addition to that, really strong profitability. And so the breadth of the business is driving durability of growth, and we're improving shareholder returns, and at the same time meeting the needs of more members. Our members and products grew 35% year over year. We're really excited about 2025. It will mark I think the best environment we've operated in since I joined 7 years ago, with rates declining and a stable economy.
Yeah, we're hoping on the rate decline part. A couple of days ago, the news was about this loan platform agreement with Fortress. Can you talk about what that'll contribute to 25?
Yes, the loan platform business is something that we started back in 2019. Initially, we would generate demand for loans that we would otherwise decline, and we pass those on to partners, and they would provide a loan, and we would get paid a referral fee. And then the next phase of that business was we integrated someone's credit model into our decision engine, and when we couldn't approve a loan, we ran that application through their decision engine, and we got paid a fee for that as well. Now we're actually getting contracts with partners that want us to produce loans on their behalf. The loans we wouldn't otherwise produce, and we get paid a fee for that as well. And so this was a big quarter from that contribution item. Again, it's high ROE, high margin, and low capital intensity.
The important thing to understand why this matters so significantly to SoFi, right, is I think people are starting to get this, and I think Wall Street specifically is starting to understand this, that when it comes to SoFi, this is not just an online bank. Right? Because a lot of people could just look at this and be like, isn't it just an online bank? No. This is way more than it does have absolutely banking components, right? And they can do some business that is absolutely just feels like traditional banking. It's just in a new age way of smartphone first, digital first, rather than physical locations like old school banks, right? But the abilities on the tech side, right, are incredible. This company has, and they're very focused on doing asset light strategies, which means they can make fees, right? And they're not as focused as taking on the risk of this particular loan. Why not go ahead, have somebody else take the risk of that? We'll just be the middleman to go ahead and facilitate that, right? And we'll make a fee off this, but then not have to take the risk if that loan goes bad, right? It's not repaid, something like that, which is awesome.
An increasingly a lot of demand for that product. We declined about 80% 80% of the applicants for personal loans at SoFi. And so we have a lot of resources that we could generally monetize. And this is a way for us to do that. So it's a low capital, high margin, high ROE way to do so. And it doesn't really come at an additional cost because there are people we'd be turning down otherwise, or volume we wouldn't have otherwise underwritten because it was above our risk tolerance or where we want our balance sheet to be.
Exactly. SoFi, he says they turn down 80% of people that basically try to get a personal loan to SoFi, right? Well, SoFi might turn down 80%, but of that 80%, there might be 20% of it that some other person would be like, or some other company, some other financial institution would be like, we would gladly give to this person at this sort of interest rate, right? And there's going to be other people that say, you know what, I would give that person a loan, right? And so for SoFi can kind of funnel that out there. Okay, you want that? We'll make our fee here, being kind of the middleman and helping facilitate this thing, right? So I love it. I love it, man. I love anything that SoFi can be asset light, straight profit. I mean, when you're talking about being a middleman, you're making those fees. It's straight profit, man. It's straight profit. And without having to take the risk of the loans.
Low capital is really the hallmark, the foundation for the transition. You've talked about 2024 being a transitional year and 2025 being the year in which you got the wind at your back, so to speak, with a lot of things going right for the business. When it comes to the nuances of the 2024 guidance raised, though, Anthony, a lot of that was driven by lending, which is not the low capital part of the business. And technology, that guidance on the platform came down for a second consecutive quarter. Can you talk to us about where you see that trajectory going as you go into that 2025 year that so many people had so much expectations for?
Sure. So the lending business grew 14% year over year in the quarter, which was a little bit above expectations. The thing that outperformed was the loan platform business, which is in our financial services sector. We also saw an acceleration in growth in the technology platform. So if you combine the technology platform revenue with the financial services segment platform revenue, that totaled about $238 million in the financial services piece and over $100 million on the technology piece. Combined, that grew 64% year over year, which is what drove the acceleration of 30% because lending only grew 14%. We've increased our outlook for the year because of strength across the entire business. We lowered the bottom ends of the tech platform revenue range primarily because our partners and potential partners have been slow to make decisions given the uncertainty with the election, the uncertainty with the economy next year, and they're delaying decisions. And we just wanted to be somewhat more cautious in that area. We're very encouraged about the demand that we see for new technology services. It's just taking longer for those deals to be decided. It's not that we're losing the deals, it's just they're not been decided, and we think we'll win our fair share. The other thing I'd say is that we're seeing really strong demand in consumer deposits, which gives us confidence on the growth of our SoFi Money business. And our SoFi Invest business is also seeing really strong trends. That's what's driving the 37% year-over-year growth in our products, which we added more than 1 million new products in the quarter.
Million new products in the quarter. Incredible. So, yeah, that was a great interview there by CNBC. I honestly think this one's even better, and the Fox Business one might be even better in terms of really getting in depth here.